Welcome back to another episode of StablePod, a podcast where we host conversations with the individuals who are shaping the future of decentralized systems. I'm your co-host, Juan Esquivel. Today's guest is helping revolutionize and accelerate asset-backed currencies. Nevin Freeman is the co-founder of Reserve, a decentralized stablecoin project. In our conversation, we touch on the history and evolution of Reserve, lessons learned from serving users in Venezuela, the launch of the Index protocol, and what decentralized token folios are. We talk about all of this and much, much more. I'm joined as always by my lovely co-host, Gustav Ehrentoft. Gustav, what did you make of our conversation with Nevin?
I think it was quite different today compared to like our normal chats or like our other chats. I think also because Nevin, he has like first-hand experience with actually trying to implement kind of like the last mile effort of onboarding and acquiring users in a market such as Venezuela, which gave him like a lot of unique insights to just like the financial troubles and situations you encounter in an economy like that. So yeah, I personally enjoyed it a lot. I really like these like a little bit nerdy financial topics. So yeah, I think it was a really, really good to talk to someone who has actually I think been doing what all of us wants to do, which is eventually to get to that like last mile stench with the customers.
Yeah, for sure. If you enjoy monetary policy conversations, but we also do touch on governance because I think it's also very interesting how with the launch of DTFs, every single new launch of a DTF, you can implement governance. So that definitely caught our eyes as governance nerds. So yeah, we hope you enjoy the conversation. It's really interesting to hear from Nevin. They operate on a long time scale. That was also a really interesting thing going into this conversation for me. How do you build this startup? How do you kind of keep the conviction? Reserve is an older protocol for those of you who may not be aware. So yeah, it's interesting to kind of hear from people in the trenches for a long period of time and kind of like this most recent, I would say, pivot or new focus for the team, which is the DTFs. It'll be interesting to see how that experiment plays out. So without further ado, our conversation with Nevin Freeman. Welcome to the podcast, Nevin Freeman.
Thanks for having me. Nice to meet you guys.
Awesome. Excited to have you, Nevin. I think we could start with your background. Could you share your journey into crypto and kind of what led you to co-found the Reserve protocol?
Yeah. Starting with Bitcoin, I had to think about, is it possible for something other than a state-created currency to be the world reserve currency? I think it was a question that many people had on their minds back in 2010, 2011, who were looking at Bitcoin. And I concluded that Bitcoin wouldn't work because of its simplistic monetary policy. Sadly, that led to me selling all of my Bitcoin very early in 2012. But that's what got the wheels turning. And, it was kind of a roundabout way that I ended up deciding to build something in crypto. It was a little bit accidental because in 2017, I was basically studying the crypto bubble to try to understand speculation in bubbles, not because I was planning to go try to build a competitor to Bitcoin. But as I learned more about it, as I saw the capital flowing into the space and just couldn't help but think about the question, ended up deciding, I actually think it might be possible to build the thing that I had originally thought maybe Bitcoin could be. And so long story short, some conversations with friends, we decided to give it a try.
Just curious, where do you think your kind of like background or things you kind of witnessed, where do you think it kind of inspired this unique mission and vision you have to basically fight inflation and expand, access to stable currencies? What do you think maybe in what you've seen growing up and stuff like that?
Well, it really, for me, actually started off more as an intellectual thing, more as observations about the world at large, rather than a lived experience, where, I ended up becoming obsessed with trying to solve problems with AI safety, actually, and thinking about other like potentially very big problems in the world. And when you start thinking about things on that scale, you end up thinking about like, okay, well, what could we do with, $100 million? What could we do with $1 billion? And you start to value capital in a way that's very different from if you're just thinking about like money, as an ordinary person, and like how much do you need to have like a nice house with a swimming pool or something. And so I was raised in a liberal mindset in a liberal town, sort of thinking like money is bad and like wealthy people are like greedy and evil and whatever. But like being forced to think about capital on the large scale of like, how are we actually going to get these crazy things done? Completely, I rebuilt my view of capitalism and money from the ground up. And that made me respect it a lot more, but also want to improve it and think about like, okay, well, but there are problems with it. What could we fix? And I was basically having those thoughts in 2010 through 2012, around the time that Bitcoin was happening, and there were those early conversations about it. And so that led me to eventually think like, oh, okay, so maybe crypto is a solution to some of these systemic monetary issues with fiat money. And then it was really, starting from that intellectual perspective. Once we started Reserve, as you may know, we spent many years offering US dollar stablecoins to users in Venezuela who were just like directly suffering from hyperinflation on a day-to-day basis. Most of our team ended up being Venezuelan at that time. And at that point, like I really came to like truly empathize with like the horrifying experience of your money losing its value, sometimes 10% or even 20% overnight. And so at that point, it became a much more sort of like emotionally driven, like, damn, we really need to fix this sort of thing. But yeah, it started off more from this like, long-term intellectual kind of viewpoint.
Yeah, I mean, now you brought it up yourself. I know we also will be going through a little bit more about like the history of like Reserve, right? I remember when you guys came out like back, was it in 2019? I believe that you first started.
Yeah, 2018.
2018, yeah. And I think, like back then we saw like quite a lot of like different, stablecoin experiments. I was with MakerDAO at the time. And I think like you guys took like a very unique approach to it, right? And I think like we're probably like the team, I think, even still today, that has put like the biggest effort into actually trying to reach like the last mile to target the end users, and then doing in an environment like Venezuela, which is arguably probably one of the most difficult environments in the world to do business in. Maybe there's a couple in Africa that is like on the same level. But can you maybe tell us a little bit just about like, what was like the decision to try to tackle the problem that way? Because I think most other teams were like, we're going top down, we're going to build up, liquidity and, a lot of like capital and traction. And then we, maybe have one or two people working on this, where you guys were really like, okay, this is our focus and this is what we're doing. So yeah, what happened there?
Yeah. We very consciously made that decision. I remember having meetings and sort of thinking through like, okay, should we basically start off by building for crypto speculators, because that is actually the market that is growing, and that's where we could create a useful business or thriving ecosystem, and then sort of branch out from there? Or should we sort of directly go towards trying to solve a problem for ordinary people, which, was sort of more of an open field, more sort of convoluted how to do that? We decided to do the latter, really, I guess, because like just the composition of the initial team was people who just kind of found the speculative stuff a little bit gross, and we just felt more compelled. It was just like, we're just going to work harder and enjoy ourselves more, and so on, if we try to solve something that feels more meaningful and real. And so we decided to do that. And, looking back, it's kind of hard to tell still, like whether that was the right move or not. I think it was, because it really built out the spirit of the project and helped us attract that many more people, not just on the team, but like a lot of our token holders like really do care about people and that sort of mission, in a way that not all token holding populations tend to. But at the same time, it was a very hard thing to do. And we ultimately ran into sort of combination of legal and political challenges in Venezuela that forced us to essentially turn off liquidity and effectively pull out of that service that we had offered. So we had this like heyday of success of doing something really meaningful and exciting. But, maybe had we focused on the sort of core infrastructure and liquidity elements and things like you're talking about, maybe that would actually have put us in a better position on some dimensions. So it's a little hard to tell, but we continue to, these days, actually, we just do both. So early on, it was like, let's just focus on that. Now we really have sort of kind of a 50-50 focus. A big part of the project that ABC Labs is the driver for, ABC is our labs company, ABC stands for asset-backed currency, is, that's much more focused on DeFi users and allowing people to invest and speculate in crypto, to earn yield, to get exposure, et cetera. Whereas Ugly Cash, the fintech app made by Best Friend Finance, is kind of the next evolution of what had been the Reserve app, what had been RPay, and is still focused on providing, basically like great financial services to ordinary users who don't care at all that they're touching crypto. And so I'm happy with that combination. I think maybe we should have done 50-50 from the beginning, although, focus is good. But yeah, ultimately we kind of made the decision just because it was the thing that tugged at our heartstrings, and we just could sort of tell that like that's where our motivations were. Yeah, like I said, I am very proud of like the spirit of the project that led to, and our community and our team and so on has this massive momentum toward like, let's solve real problems. And so I don't even have to push things in that direction at all. In fact, I was one of the forces who kind of was like, hey, maybe we should like cater to some speculators. Maybe we should acknowledge the existence of meme coins, et cetera, where the team was sort of like, oh, really? Like, are you sure? Like, that seems kind of crazy. Like, people actually came to me being like, Nevin, I don't know if this is a good idea. It's kind of messing with like, some important things to us. And I'm like, no, I think that there's reason to do this. So it's funny. I kind of push us in the do real things direction. And then later I'm like, well, okay, let's also, exist in crypto circa 2025 as it is today as well.
Yeah. I mean, I think also like back then, I mean, DeFi was very small, right? So like in 2019 was, I think, it was like the year when Uniswap launched, right? And, Compound and, I think Aave was like the late in 2019. So also, I mean, back then, it was not like you had this huge DeFi market that would have been amazing.
No, that's true. I remember the Maker team had identified, building liquidity on decentralized exchanges as a core goal for DAI, and that was like a forward-thinking, speculative, novel bet at the time. Looking back, it's like, well, obviously that was actually a great move. So
yeah, very true. So I just wanted to know, so, I mean, of course, like, I take the assumption that you guys were kind of very happy with the work. But, since like today, I think the goal for most Web3 projects is still to try to solve some kind of like real life, problem and use case. So maybe you can just tell what are like some of the biggest learnings and like takeaways that you guys have from the project you started out kind of like trying to solve in Venezuela?
Yeah. So for anyone who doesn't know, just to the basics, we offered a cloud custody stablecoin wallet, meaning you don't do the transactions on chain. We hold the stablecoins for you in Venezuela, and we made it possible to hold your money in dollars, basically just have like a dollar account in a simple kind of cash app like way. But we gave you liquidity in and out of the local currency of the Venezuelan bolivar, as well as getting money in and out of, bank accounts. There was liquidity with Zelle, PayPal, et cetera. And so just in terms of numbers, we got to, I forget, 700 something thousand users, I think 27,000 merchants. And in terms of payment volume, it was like $350 million in monthly transaction volume before we ended up deciding to back out. And so, what are some of the biggest learnings? So two things that were really surprising to me. One was you would think that if you live in a country where the currency is losing its value that quickly, the bolivar would frequently lose 5 or 10% overnight, that everybody would just be trying to flee that currency into a stable currency, and like all of the demand would be in one direction. But actually, that's not true. The trading in a country like that, in and out of, like, say, the US dollar, is actually pretty balanced bidirectionally. And that's because people still have to make payments in the local currency all the time. And companies have to make payments in local currency all the time. And so, yes, everybody tries to store their money in dollars, whether it was in the Reserve app, or if you're a company, you'd probably not store it in our app, you'd store it in some American bank account. People always have to trade back in. And so that meant that it was actually quite feasible to have a liquidity mechanism where we had dozens of independent liquidity providers, they were called, who offered liquidity within our app ecosystem to allow people to deposit and withdraw, to convert back and forth. And the spreads were quite high, often like 5% between the buying and selling price. That's what a market maker would have to charge in order to make it feasible to deal with such a volatile inflationary currency. But the flows in both directions were often matched. And actually, the first use case that caught on was actually people moving money from dollars into bolivars. We thought our problem was going to be that everyone wanted to move out. Actually, everyone wanted to move in because they had been earning money in PayPal and had gotten stuck in PayPal. And the only way to get it into bolivars before we came along was like informal, finding someone on Facebook or WhatsApp and doing some informal trade and paying like 12% or something. We could do it for like 5%, which is still like a high cost, but it was just much better. And so our first flows were mostly just moving money into the inflationary currency. It was kind of weird. So that was one thing that was really surprising. Another thing is just that, like, the way that a government and a central bank thinks about capital controls in reality is, I think, actually quite different from what people sitting in Europe or the US like tend to think. We tend to have this simplistic view of like, oh, they want to control, they want to force their citizens to keep value in the local currency because they want to stop them from fleeing to other more stable currencies. And so it's sort of like a propping up of demand thing. In some sense, maybe that's a motivation, but like realistically, people are going to trade out one way or the other, whether you allow them to do it through your central bank channel or not. And everybody knows that. So there's really no way in which you can force people in your country to stay in your currency if some other currency is more attractive to hold. What actually ends up being the operational concern is maintaining the balance of dollars that country's central bank holds so that they can offer a favorable exchange rate to their own internal companies that are running import businesses, because they depend, every country depends on imports of certain types. Some countries depend on imports a lot more, especially if your country mainly exports oil and imports everything else, you really depend on imports. So you need to make sure that your central bank has the dollars in order to allow your importers to get good prices and thus sell goods for good prices to your citizens. And so it's a much more practical exercise of like, okay, these are the parties that we're going to allow to trade through this channel. We're going to give them this exchange rate, so that our economy works. It's more about that on a day-to-day basis than about like sort of forcing the citizens to not hold their savings in foreign currency. You sort of know that they're going to do that, but you know that instead of going through your channel, they're going to go through some external channel. They're going to buy stablecoins, or they're going to buy cash US dollars in the sort of informal market, or they're going to do some trade where they buy bonds and then they sell them on a foreign market for dollars. You're actually fine with all those things. Those don't bother you because they're not messing with your dollar balance and the particular economic flows that you're in charge of managing. So I was very surprised to learn that was actually what was at issue. And a lot of this informal exchange that happened on the side wasn't something where like government agents were like roving the streets trying to find people and like stop them from doing this. It was actually relatively, and is today, quite commonplace and allowed in countries like Argentina and Venezuela and others around the world.
Wow. Yeah, that's really fascinating. I mean, it sounds like you got a crash course, of course, in terms of economic monetary policy and kind of like the ins and outs of maybe regulation, right? There was some aspect to that, right? As you were trying to maneuver that government over there. That's really, really interesting. I do want to transition us over to actually speaking about, Reserve protocol as it stands today. But before we do that, maybe could you explain kind of what you were doing on what the project was focused on early on? Could you maybe, for our listeners that maybe lack the context of kind of how it's slowly evolved into what it is today, could you maybe just quickly kind of like, we did this and then we did this and now we're doing this, just really quickly?
Yep, totally. So, like many crypto projects, start off with a white paper of, here's a design for a stable coin that could be pegged to the US dollar or maybe one day independent of the US dollar. Then we ended up spending a lot of time on the project we've just been talking about, the Reserve app and RPay in Venezuela, led by Gabo Jimenez, who has a background trying to solve the inflation problems with crypto in Venezuela, first with the government and then later with us. He's still in charge of Best Friend Finance and the successor to that today. Then we got around to actually launching the full version of the Reserve protocol. The Reserve protocol basically allows you to create a token that's backed by a basket of other tokens. And the basic idea there is that maybe the correct form of money in the long term for the world is, rather than a single asset like the dollar or gold or Bitcoin, maybe it's it's an index of many assets that is represented in a token. The basic, and so I'll talk more about that in a second. But yeah, so we launched the first version of the protocol, which is now called the Reserve Yield Protocol. It's optimized essentially for getting yield. So ETH Plus and USD3 are like the biggest assets there. ETH Plus gives you like diversified ETH staking yield because it's like an index of ETH staking assets. USD3 gives you sort of diversified DeFi yield on dollars because it's like an index of dollars that are lent out in DeFi. And then more recently, we've launched the Reserve Index Protocol, which it does a very similar thing. It still allows you to make a token that's backed by a basket of other tokens and redeemable one for one, but it's more tailored to the use case of basically an index that gives you exposure to many different crypto assets. And so it has a number of technical differences. Instead of like with the yield protocol, it's tracking yield and it's basically charging the users as a fraction of the yield generated. The index protocol instead allows you to charge a flat TVL fee. And so it allows you to include assets without oracles, and it's much more flexible. You can create many more different types of products with it. So those are the basic things that the project has done up until now. And to just put that in a little bit of perspective of like, well, why? If the goal is to beat inflation, why create this sort of like, index investing platform or, these yield tokens? The long-term vision, the idea behind Reserve eventually is asset-backed currency. It's the idea that rather than having, like I said, gold or Bitcoin or the dollar or the euro as your main currency, what if your currency was just an index of basically all the world's assets, right? And the basic intuition behind that is like very simple. There's nothing fancy about it. It's just like, if you think about it, anybody who amasses any significant amount of wealth today typically doesn't store that wealth in a single asset. You don't like become very wealthy and then put all of your wealth in gold. You hold a diversified portfolio of assets, usually, some amount of equities, some amount of bonds, maybe some gold and some crypto. Some real estate, typically. And so it's like, okay, well, the market has basically kind of decided the right way to store value is through diversification. It's not by holding a single asset, even if a particular asset has like great, supply dynamics like Bitcoin or gold, you still don't necessarily want to concentrate all of your wealth in that one asset. And so our take is like, well, with modern technology and hopefully with modern policies and regulations that we create in the coming decade, we'll see how that goes. We just don't see any reason why you shouldn't have a token that's like freely transferable to anyone around the world that represents an index of everything, or an index of whatever it is that the market decides is like the consensus store of value. What I mean by that is, if you look at ETFs in the stock market in the United States, for instance, I don't know much about foreign stock markets, but in the US, the S&P 500 ETF is far and away the biggest one. It's like the most popular. And so that kind of is the consensus benchmark store of value, where it's like, okay, just hold an index of the top 500 companies. That gives you like a pretty great exposure to the market. It's simple. It was the first one. I don't know if that's the reason why it's the biggest. You know, maybe some sort of index of 1,000 would be the biggest if it had been the first. I'm not sure. But in any case, the point is that over time, you know, it's like if there were easy payment rails for it, it could be that you could transact with many people by spending units of the S&P 500 ETF. But we just don't think about it that way. It's just not set up to transact that way. But imagine if there was a consensus portfolio like that was worldwide, that was, you know, include equities from all around the world and maybe some bonds and commodities and so on from all around the world. Imagine that it ends up being like a power law where that is the sort of natural thing that most people end up holding. And it's just a crypto token that's like super easy to transact with. It's a very natural thing to then start doing your exchange with that asset, we think. So that's basically the long-term perspective for Reserve. The reason to build all this is we think that it's possible that the US dollar will have major issues in the coming, 30 or 50 years in the way that past reserve currencies have. And we think this might be the best backup option to have lying around.
So yeah, like I think you make like quite a lot of like good points, and I think it sounds, of course, like a quite like logical way. However, I mean, I know some of the problems you have with, I mean, for example, like the S&P 500, I think it used to be very diversified. I think in the last 10 years with the tech boom, it's become less diversified right now. Like right now, if you hold the S&P 500, it's basically something like, I don't know, like a pretty significant portion of your funds are just invested in, a handful of companies because they've become significantly larger than anything else. And in the end now with the S&P 500, where I think it should have been kind of like this way of having exposure to, a lot of different industries, and, you wouldn't really have like the circular problems and stuff, but now you just have a great exposure to tech. So of course, like if you would have it and you would say, okay, it's not just, stocks, it's also like real estate and bonds, and it's kind of like this like very diversified portfolio. I guess you could kind of like alleviate that a little. However, I mean, I think, maybe apart from gold, but most like in like invested asset classes still has, some of the same volatility profile, I would say. So, this index, I mean, I don't know, maybe you can tell me how it would be possible to have it without, having like significant ups and downs. But wouldn't you come a little bit back into the situation that I think in general people have this like, mental or psychological barrier about spending something that goes up and down in price? Because, I mean, if I could buy things with, my ETFs, I probably wouldn't do it, right? Because, I mean, I would rather just do it with my euros, right? Or, if I could get paid in ETFs, I'm not sure if I would do that, just because, it might be a bad day or it might be a good day. But in general, you kind of like take on that volatility risk, right? Which is a little bit the same if you have currencies that behave in this way. I used to live in Argentina, so I have a very good relationship with how it is to be paid in Argentine pesos. But yeah, so maybe you can talk a little bit about like how do you see that problem? Because I think that's kind of like in a lesser way, but it's the same problem that also plagued a little bit, like Bitcoin and Ethereum as money.
Mm-hmm, mm-hmm. Yeah. There's kind of like a. Well, let me share one sort of like very simple kind of just perspective type answer, but then there's also kind of a more interesting technical take on this, which is, so, it's like today, if you have gold in your portfolio, you don't spend that gold to like buy an ice cream, right? And even if there was an easy way to like maybe in Robinhood, like set it up so that your card like spent the gold balance, you probably wouldn't choose to do that, right? Because you're probably holding it because you think it's going to like maintain its value better than your cash or maybe increase in value. So it's like, you're going to spend your cash just quickly, because the cash is the thing.
You can actually do that in Revolut. Sorry, you can actually do that in Revolut. I know because 5 years ago I spent ETH on buying something by accident.
Yeah. Right. I would love to know the stats on how many people choose, to spend something that's very volatile. I would guess it's very few, for just the reasons that you outlined. So, but at the same time, if you existed at a time when gold coins were the main unit of account and means of exchange, you would have been spending gold all the time. The point being, like, there could be a paradigm shift. Big things would have to happen for that to occur. But let's take Argentina. If someone like Milei were to say, okay, we are switching currency, and we're switching not to the US dollar, we are switching to this asset-backed currency, that is going to be the money, you could potentially get a whole population on board with, like, okay, that's how we're going to think about it. We're going to price stuff in terms of this asset, whether it's gold or a diversified portfolio of assets. And if you had a large enough population doing it, then it might become natural to spend that thing because that's what everyone is expecting you to pay in. And if you think about it today, you have your balance in ETH, say, and you have your balance in dollars or euros or wherever you live. Well, yeah, you're going to spend the cash because you don't think it's going to retain value as well. But in this world, you wouldn't have to have a balance in fiat currency at all, right? The whole point is to get rid of that part of your sort of financial stack. And so if you were able to just have one of these assets like gold or a basket of assets, and then just incrementally spend a little bit of that at a time, you would actually do better than if you had most of your wealth in that, and then you sort of had your checking account in fiat money that was constantly losing its value, right? So anyway, the point is you sort of eliminate the decision paralysis if everybody's doing it, and you actually end up doing better financially if you don't have part of your assets in an inflationary fiat currency at all times. But I think that there's still this really important question of, would any portfolio of assets, any basket of assets, be stable enough in real value terms, in purchasing power terms, to use as money? And the answer is not obviously yes. And so the one problem that we think about, and if anyone listening to this finds this interesting and wants to come work on it with us, we're actively hiring for people to work on this, is basically thinking about, like, okay, is it possible to basically smooth out short-term volatility in such a portfolio without paying too high a cost to get that volatility smoothing? Let me break that down a little bit. Let's take an example and let's just say our asset-backed currency, because we were using this example before, let's say it is just like the tokenized S&P 500. It just has the 500 equities and nothing else. Okay, so now you have the sort of like, max drawdown of 30% or whatever that you deal with the S&P 500. You don't want your money to lose 30% in a year. That's like a lot of purchasing power to forego. But on average, those assets do tend to appreciate over the course of any given year. And so you do have this increase of value to play with. It's like, okay, we are sort of appreciating in value generally, or appreciating in purchasing power terms, not just dollar terms. And you don't necessarily want your currency to appreciate in value. Like, in my mind, at least, the ideal currency is basically like perfectly stable in real terms, in purchasing power terms, in terms of the amount of rent you can buy, the amount of gas you can buy, the amount of food you can buy. And so the point is that you can take that appreciation, that revenue, that's excess value that you actually don't need to back your currency, and that gives you a budget to basically pay for volatility reduction. You can pay somebody or some investor class to absorb the downside in exchange for them getting the upside. That's the high level idea. Now, there are different ways you could do that. So one way you could do that is baking it into like the protocol itself, where you have some sort of mechanism that's designed into the protocol that creates this sort of relationship. Or maybe the protocol doesn't need that. Maybe you're just managing like a portfolio of options or some other set of derivatives that are just part of the basket. And so you're constantly, spending some of the value in the basket to pay for those positions. But then in the events of, depreciation of some of the assets in the basket, you've hedged that volatility. It's an open question to me whether it's better to do this on like the protocol level or to just have this be part of the composition of the basket itself. That's something we're thinking about a little bit right now, not as much as we want to be. We want to hire more people or make grants to more people to think about this. Because ultimately it could be that you need some sort of volatility reduction mechanism to get something that really does feel stable enough on like a day-to-day, week-to-week, month-to-month, year-to-year basis. Even if it's obviously a much better store of value than the dollar over the course of 10 years, that doesn't matter if it's not stable enough in the short term. And so for the end game of reserve, that's where we're going. Let me say one more thing to tie these all together. So, DTF stands for Decentralized Token Folio. And just to be clear, we intend for that to be an industry-wide term. It's not that DTFs are the only things that Reserve makes. Enzyme, Index Co-op, or other big protocols that are sort of similar in size to Reserve that make what we would call DTFs. And a DTF, the idea is it's like an ETF, but in DeFi. And all of the products that Reserve makes, the yield R tokens and indexed R tokens, we think of those all as just different types of DTFs in the way that you can have sort of like an ETF that's kind of like a money market fund or an ETF that's more like an index with broad market exposure. And to put it in those terms, our end game, the way that we're thinking about that with that volatility reduction, we think that structured products are going to be a big category of DTFs in the way that structured products are gaining in popularity in TradFi, where for anyone who doesn't know, a structured product is basically something where there is some counterparty on the other side that's taking some, basically taking some downside in exchange for, some upside that you give them as well. So like you can buy, structured products that are offered by banks where if the stock market does anything other than going down like less than 20%, you get a fixed like 7% return in dollars. If it goes up 20%, you still get your 7%. The bank gets that extra upside. But unless things go really, really badly, you have no risk of losing money. That's an example structured product. And DeFi, smart contracts, are an amazing infrastructure for creating all manner of different types of structured products because you can program all these arrangements. And so we think that one category of DTFs, like right now we're focused on indexed DTFs because we think just broad market exposure, that's where the next step is in the evolution of DeFi and crypto and DTFs on chain, we think. But structured product DTFs, we think are going to be big over the course of time. And essentially, a flat coin structured product DTF is our long-term vision for what asset-backed currency will look like. And so we're just sort of building the infrastructure, and we think that all of that will end up being created and popularized over, decades.
Very cool. So first off, I think anyone who has, a deep interest in financial products and structured products should definitely reach out to you guys. And I think it will be an amazing journey to be on with what you guys are building. And then also I noticed some things, now you're kind of like, I think like mentioned it a bit, right? That, like maybe like a country in the situation such as Argentina, Milei has kind of like fixed inflation for now, but if we go back, a year or like a year and a half, I think historically we have of course seen also, as you talked about in the beginning, that, there's these kind of like monetary policies that I think like the governments, would like to kind of keep internally in the country. Is your like long-term vision that, countries might be in a position where, managing their own, monetary policy and fiscal policies are not beneficial to them to the extent where, they would rather buy into a product such as this? Because, of course, I live in Europe, you live in the US. Our currencies are not always behaving like we want them to, but at least we have pretty privileged lives with the euro and the dollar. But of course, I would say probably like the majority of the world live in countries where the local currencies are not, as performing as well, if not even more. I don't know the exact numbers, but like, do you see like a future where countries would be like, hey, this kind of like fiscal and monetary policy adjustments are just not working out for us, and we would potentially look to like a third party for a solution?
Yeah. So that what you just described is effectively the decision a country makes if it decides to dollarize. Which some countries, Panama and Ecuador, for instance, in Latin America, have done that. And as you say, when you do that, you give up control of your monetary policy to, whoever's in charge of that currency. It's an interesting thought experiment to think about if you were to adopt such an asset-backed currency. You wouldn't quite be importing the monetary policy decisions of another country in the same way, because it's just this neutral sort of platform that, you have to worry about like who can co-opt its governance and who can steer it and so on and so forth. That's a whole nother conversation. But if you manage to create something that's credibly neutral, that's not co-opted and run by one country, then it is a way to reduce your own monetary policy levers, but without giving up as much control to some foreign country and importing their monetary policy. Now, one thing I want to call out, though, is I don't know that you really have to fully give up all of your monetary policy levers, because suppose you made an asset-backed currency like this your main legal tender and you had no fiat money. Well, you could still have your own internal commercial banking ecosystem that your regulators had control of. And so one monetary policy tool, for instance, that banking regulators have is to decide, what are the like reserve requirements of their commercial banks? How much sort of capital does the commercial bank need to have on deposit with like the central bank relative to like how much they loan out and the sort of like credit expansion of money stuff. It's weird because usually we're thinking about central bank balances as being in the currency that the central bank can create, but that need not be the case. You could actually have like a central bank where it's like you as the commercial bank have deposits with me, the central bank, in this asset-backed currency. And then your loan rules and so on are dependent, or ratios that are set based on those balances or whatever. I'm not an expert in all of that, but it's actually something we're about to hire someone to be thinking about those monetary policy questions, because I think that that's an important piece of all this. And thinking about that end game is like, exactly what are you giving up in terms of monetary policy, and actually what would you still have control of if you were to use an asset-backed currency? And I think that the answer is not quite as black and white as it might seem. And just in planning out the future and thinking about what offer would we be making to central governments of countries, that's something that we're keen to get deeper into ourselves and our own understanding.
Nevin, bringing us back to the DTFs, could you elaborate a little bit about like what kind of innovation do you think DTFs bring to the table over traditional ETFs? Maybe what they can and will enable in the future?
Totally. I mean, one thing that's just so cool about DTFs as of today, we actually on Reserve, we haven't opened up the permissionless creation UI yet because the team's just trying to make sure that there's no issues that are going to cause problems there. But we will in a matter of weeks. And so with a DTF, anyone can make one in like 10 minutes. And then once you've made it, anybody can mint it and anybody can redeem it. So, with an ETF, it's like this complicated process. And, because you're dealing with these centralized assets, you have to worry about all the custody and like who's going to hold it and like all the requirements there. But also, with an ETF, a normal market participant, they can buy it on an exchange, but they can't go to the ETF issuer and like deposit the underlying to like mint the ETF or redeem it. Only like specialized parties can do that. With DTFs, because it's in DeFi, just like anybody can do that. Like our website, like when you go to buy, if there's a better rate that you can get from minting, where like the in the background, it trades into all of the underlying on all the DEX pools and then mints it for you. If that's a better price, it just does that, and that's all automated for you. So it's kind of an insane leap in just like the extreme openness of like anyone can create it super easily, anyone can mint it and redeem it. Nobody's holding the assets for you. Obviously, they're just held, in the smart contract. So in that sense, it's just a level of openness and simplicity that's very different. But on the flip side, you're limited to just tokens, and many financial assets that the world cares about are not tokenized yet. So for now, we think DTFs are, yes, there is a rising tide of RWAs, and we're excited to be part of that. But in the beginning, really these things are still very inwardly appealing to the crypto world. We think it's not like your dad or mom are going to want to buy a DTF instead of buying an ETF for a thing they would normally buy an ETF for. We're still like maybe a decade away from something like that. But yeah, it's kind of just like all of the normal magic of DeFi reasons apply in this case. And we do think that in the way that Uniswap lowered the barrier to creating a trading pair and providing liquidity such that now you can sort of trade anything on DEXs. We think the same thing is happening now with basically indexed ETFs, where there's going to be zillions of indexed ETFs, and anyone's be able to make them, anyone's going to be able to trade them. And so it just sort of like breaks everything open in terms of the permissionless, DeFi Lego, as opposed to depending on centralized parties like exchanges to decide, okay, this is the one or two indexes we're going to offer. So I'm very excited to see kind of the explosion happen, just like we saw with AMMs. I think that's going to happen with DTFs.
Yeah, I think one of the unique features that we just didn't have enough time to touch on, but I did want to call out before we wrap up the conversation, which is that each DTF allows some type of governance if that is what the creator decides to implement. And I think that's very interesting, and that would enable a lot more DAOs, a lot more governance structures, and of course that is our area of expertise. So I just wanted to call that out.
No, that's a great point. I'm really glad you mentioned it. We have like a default form of decentralized governance that's like basic token voting that you can just click and say that's what you want to do. But on a technical level, these things are designed so that any smart contract, any Ethereum account, or you'll be launching on Solana soon, same pattern there, any DAO can manage it. So it really does, it does mean that as our UI supports more and more options, or if like people who are technically inclined decide to hook these up to other things, you can really explore really any possible means of decentralized governance for managing these things over time, which we're very excited about. And internally, we're even thinking more about different possible governance designs right now. It's something that, maybe we'll get to release more options pretty soon. We'll see.
Sweet. Well, gentlemen, I do want to call it the time. Just some last minute questions for you, Nevin. Is there anything you want to tease? Anything that people could look forward to from Reserve over the next 6 to 12 months?
We're pretty boring in terms of teasers. We don't want to set expectations and then disappoint. So I think we don't have anything exciting to tease. We've already noted that we're working on a Solana version, and we'll be releasing that sometime soon. So let's see. Is there anything?
Any call to actions? Any user feedback? Anything you want them to kind of go play with?
Yeah, I mean, I would say if you're listening to this and enjoying these concepts, go mint $5 worth of a DTF. And then just redeem it if you don't want to hold it, just to like have the experience, and click the feedback button on the bottom right of the site and tell us what you thought. We're super focused on user feedback and improving the product right now, or the ABC Labs team is, I should say. And we're very early days. Like we've asked the team internally, hey, so is everyone going to put 25% of their non-RSR crypto into DTFs right now? And for a lot of people, the answer is no. It's like, okay, great. Well, that's our to-do list. Like we need to handle, all of those issues. And so we're very focused on, honing all of the rough edges right now. So this is the very beginning. Go try out index ETFs. Tell us what you think is the problem and we'll fix it. And you can be part of the story with us.
Awesome. Cool. And where should people go? Reserve.org?
Oh,
anywhere else?
Yeah. Reserve.org. The app is at app.reserve.org.
Sweet. Gustav, any final parting words of wisdom? Anything you want to share?
I really enjoyed the conversation today. I mean, I have a big interest in especially like financial situations in emerging markets. So yeah, it's super cool to hear what you guys are building, Nevin, and I wish you all the best of luck with it. And it's also really great to, have a conversation with someone who is not thinking 1 or 2 years ahead, but who is like, in 10 years, that's the end game, maybe even longer.
Totally. Yeah. Thank you guys for having me. And by the way, just to say, we're huge fans of StableLab. StableLab, plays an important role in governance in the Reserve ecosystem. I sit as the president of Confusion Capital, which is in charge of making grants in the ecosystem. We're happily re-upping StableLab's grant soon for more governance participation, and anyone else out there who's looking for that type of governance support, they get our full thumbs up. So thanks for everything you guys do.
Appreciate it.
Thanks for the plug. Thank you for the conversation, Gustav and Nevin. We'll see everyone on the next episode of StablePod.